In the great words of Monty Python, and now for something completely different. We're going to be talking about macro and crypto and how those worlds collide. So I'm excited to be joined today by, I'll let them both introduce themselves, but maybe we'll start with you, Joseph.
Oh, hi. My name is Jauvin. Some of you might have seen me on Forward Guidance before. So I run an registered investment advisory called Monetary Macro, and also I write a weekly newsletter at fedguide.com. So my background is in central banking and financial markets.
Austin.
All right. Hello. I'm Austin Campbell. I am a professor at NYU. I unfortunately know more about stablecoins than is probably healthy for any individual human being, having run and built some myself in the past. And I have a long and somewhat tortured career in traditional finance as well.
Nice. Well, that really sets the theme here for what we're going to be talking about of tying those two worlds that seemed very different and separate just a couple years ago, or even just 6 months ago, and seeing how those two worlds are colliding. So I want to start by just digging into getting everybody up to speed on what's the right way to think about macro as it stands today. So obviously we had the FOMC meeting yesterday. There was no real surprises there in terms of the rate cut changes, but there was a lot to dig into. So I'm actually going to pass it to Joseph. I would love for you to just explain what were your main takeaways there. How are you thinking about the FOMC today in light of what's going on the fiscal side as well?
I think the FOMC meeting could be summarized by so basically, Chair Powell, if you look at his projections, March FOMC was one of those special FOMC meetings where we get dot plot projections. You can see that the FOMC is really, really uncertain as to what the world will look like in the future. In the dot plot, basically, members there say that the risks are to the downside for unemployment and very high uncertainty. And for inflation, risks are to the upside and also very high uncertainty. We have a lot of things happening in the world that make macro super interesting. When it comes to policy, you have changes in fiscal policy through DOGE, you have changes in immigration policy through enforcement of the border law, you have changes in regulatory policy, which many people have been discussing today, but that actually impacts a whole aspect of industries from oil to banking. And of course, we have some changes in trade that we will find out on Liberation Day on April 2nd. So we have all these things happening right now, and so no one really knows what's going on. So the Fed has basically committed to be reactive, committed to basically be late no matter what happens. So what they're going to do is that they're going to wait and see what happens, look at the data, and then react. Now, my best guess is they're going to find out that the data doesn't actually look so good because of all these changes, and we'll have some aggressive round of cuts. But at the moment, the market is only pricing in 2 cuts this year, which is also what the Fed guided towards at their dot plot. Now, one other thing that happened at yesterday's FOMC that was pretty interesting was the stance of the Fed's balance sheet policy. Now, a lot of people build investment strategies as to whether or not the balance sheet is increasing or decreasing and so forth. Well, for you guys, rejoice, because yesterday the Fed effectively ended quantitative tightening, which is to say that they are not going to be shrinking their balance sheet, at least as much. Now, quantitative tightening was going on at a pace of about 25 billion a month for treasuries. Now it's just 5 billion, which is really small. I would say QT has virtually ended. So the Fed is, markets like that a bit. You can see the treasury market feeling a bit more supportive of that. But overall, it was a meeting that wasn't that impactful, because going forward, all the macro is going to come from the White House, from Congress. So the Fed is really not going to be as important as it used to be. So I think that's how we'll summarize the meeting yesterday.
Austin, so before you got wildly obsessed with stablecoins, you did used to be a rates trader. That was your world. So I'm going to tap on that world for just a little bit here before we get too deep onto the stablecoin side of things. But what's your high-level framework for how to think about macro today? Is it just, being fully focused on the fiscal side of things? What's your current perspective on monetary? How are you characterizing that?
Yeah, I think, all right, so let's zoom out a little bit from the United States, actually, which I think is a useful exercise right now. We're used to thinking in the United States of ourselves as a country that has a relatively clean fiscal situation and clear monetary policy. And historically, so if you're thinking 90s, 2000s, you would look into emerging markets to find most places that we would think were in significantly worse shape. But one of the things I've been observing from a macro perspective is lately the United States itself has started to trade more like an EM sort of exposure. And maybe the best example of this was when we cut rates in the short end of the curve and the long end of the curve went up. Right. Like I remember having a long discussion with a friend of mine who traded Brazil about that exact behavior there. And the other thing I would point people towards is we now have corporates in the United States funding cheaper at the 30-year point than the federal government. Right. So let me repeat that. Corporations are less likely to go bankrupt than the federal government. Okay. What that means to me, and back to what you were saying, is that this kind of puts the Fed in a no-win position, and that's why they're very reactive. Because if you cut, you're going to control the short end and lose control of the long end. If you raise rates, you're going to crater the economy, but maybe the long end looks a little better. And so we're in a position where, quite frankly, the fiscal is leading the monetary in a way we're not used to in the United States. All of this comes down to until people have confidence that the deficit will not be like 200% of GDP, then all of this behavior gets much more like you would expect from EM countries than the US. And that's kind of the framework I'm viewing everything through.
Yeah, Joseph, taking that mantle of this dynamic of what happened in September, where, yeah, we started off with the 50 bips cut and we saw the long end sell off quite significantly. You're calling for 4 or so cuts for 2025. And to your point, the Fed's only at 2, the market's around there as well. If we were to move forward into these accelerated cuts, what do you think is the impact on the long end there in that respect? Because to what we've already been saying here is that the Fed has been burned a couple times too many, where now they're somewhat complacent and slow to react. What does that do to the market? It's like the fixed income market.
Well, first off, I really like Austin's idea of the EMification of the United States, because you can kind of see that in a few ways, right? We have a rampant fiscal deficit. We have, some people perceive it to be weakening rule of law. And so, and a lot of times the fiscal authorities seem to be much more influential than the monetary authorities. Now, one other thing that's very common in EMs is you have these tremendous boom and bust cycles, whereas you have, let's say, high interest rates in an emerging market, foreign capital rushes in, harvests those higher returns, and then, one day they all rush out, and that causes the financial markets of the EM to tank. You kind of have this happening right now, right? So this past month, you have a huge amount of repatriation of foreign flows moving out of the US into places like Europe because of rearmament, maybe to China, where there's been a lot of interest in the tech sector there. So you kind of see the US financial markets tanking because foreign capital leaving, basically just what would happen in an EM boom and bust scenario. So that's definitely something we want to keep in mind as we go forward. Now, thinking about what would happen to the short end, so my base case, what would happen this year is a replay of 2018. Now, the U.S. is still, I think, has a lot of things going for it. Ultimately, it still has a reserve currency. Still, the dollar is the international currency of choice. We still have very deep and liquid capital markets and are perceived by many to be a good destination for capital. So I don't think we are fully going to change that anytime soon. But in the event that we do have a significant risk-off event like we did in 2018, now for those of you who don't remember, in 2018, the markets were probably down 20% from peak to trough, basically sold every single day into December, and there was some real panic everywhere. But at that time, the markets began to price in a lot more rate cuts because they were afraid of recession or something worse. And so I think that's going to replay right now. So if we were to have a significant correction, given that the trade policies today are much more severe than they were in 2018, we'd have a big correction in the market. I think that would still give us a flight to safety bid at the moment, or at the very least, the market would price in more rate cuts, and I think that should put downward pressure throughout the curve. I don't think it will last. I think that going forward, given all the trappings of EMification, we could see higher, longer-dated yields in the future. But for this year, I think there's still a good safety bid if we do have a big market correction like I think we have. And we were down 10%, but I don't think that's big, guys.
Are either of you guys in the camp of, so, okay, we've had a 10% correction so far in equities. The cost of that was significant compared to the 50 bips bond rally that we've had so far. We've been hearing this notion that they want to get the 10-year yield down. We were joking earlier about how they're making it very explicit that is the all intents and purposes goal of the administration right now, which is quite significantly different from the last term. So, there's this idea that they can see some pain and then just beautifully come underneath and catch it with a nice soft cushion, and there won't be any sort of recession. At most some sort of growth scare. So I want to ask you both, how likely do you see that scenario as occurring versus, if they're playing with fire here, how likely is it that could get too carried away?
All right, so I'll give something of an off-market opinion. I don't think recessions are necessarily a bad thing. Right. Creative destruction exists for a reason. You don't want an economy where you have relatively inefficient and failing firms that just stumble along forever as zombies. Right. That's not a good way to run things. And using monetary policy, right, or fiscal, quite frankly, to immunize your markets against volatility doesn't get rid of the volatility, it just hides it. And then eventually it's going to show up all at once. See, for instance, 2008. And I would suggest that I don't think it's a good idea to be thinking about exactly when to catch this thing. I think the right thing to do is think from a first principles basis about what is good fiscal and monetary policy, period, full stop, and just do that. Consequences be damned, with the caveat that there is, of course, some level of consequences that is too severe and people start collapsing your government and things like that. Don't let it get that far. But the barometer should not be recession or no recession or growth scare or no growth scare. Those things are fine, right? The thing should be, are we putting the country on a long-term, sound set of fiscal and monetary policies that when we look back 20, 30, 40, 50 years forward, we will say laid a foundation for sustainable growth?
No, I completely agree. I mean, so a lot of things that are being done right now are very disruptive. So the Government Accountability Office under the Biden administration gave an estimate that there could be as much as $500 billion a year in fraud in the federal government, right? So if we were to have that to be better distributed, that's a good thing. And of course, having a recession, we move some resources from where they're poorly used to where they can be better used. That's better for long-term growth, right? And looking at trade policy, so the administration wants things to be made in America. It wants to rebuild the industrial capacity of the United States. Now that's important for security reasons, but if you look across the world, other countries that have very restrictive trade policies, like China, for example, have been able to build a very successful manufacturing economy, right? Literally lifting hundreds of millions of people out of poverty. So there is a path towards this that could be leave the United States in a much better position than it is today. I think the market is too dismissive of that, and that is definitely a possibility depending on many factors. But with the administration is staffed with smart people, so hopefully we'll get there.
So one of the major dynamics that characterizes this EMification that we keep talking about is when a country starts to issue more short duration than long duration. And that has been the theme of the past few years. We've seen the Yellen Treasury and the Biden administration heavily weight T-bill issuance. So now we're getting into this dynamic where we have a lot of the short duration that just keeps having to be, rolled and refinanced here. And then the big question of, and I think it's related to this idea of the Scott Bessent Treasury talking about trying to lower yields. So, underlying a lot of these themes is this idea of, okay, who is going to become the next great marginal buyer of duration? And the way I see it is that there's a lot of different existing levers that can be pulled, but there's two new innovative ones. And the first one, and I'm going to ask this one for you, Joseph, is this idea of, we've heard it be called the Mar-a-Lago Accord. We've heard this idea of century bonds being potentially issued to other countries in exchange for security guarantees. 100 years, zero coupon bond, that's a terrible deal for anybody, but the idea is that's just the cost of doing business. How likely is that? And then I'll come to the next lever to you, Austin, after.
So the Mar-a-Lago Accord comes from a paper written by Stephen Moran, who is now the chairman of the White House Council of Economists, also a former guest on Former Guidance. And, and in that paper, he discusses one of the solutions the US could deploy to try to create demand for its debt. And that is to say, we go around the world and say, hey, we protect you. Protecting you is very, very expensive. So how about you share the burden and maybe buy some of our debt? So That, I think, is a strategy that could work for some countries, but probably not very many. If you look across the world, a lot of countries simply aren't very dependent upon the US security umbrella. And I think some of them would actually say the US is the greatest threat to their security. But there are countries that are highly dependent upon US security. For example, Japan, always been a very good ally with the US, very close military ties. Maybe a country like Japan would be willing to sign up for something like that, a Mar-a-Lago Accord. But I think the amount of juice we could squeeze out of this probably isn't that much. A much better way would be the banking reforms that maybe we could talk about later on, and also another very new and ingenious solution that I guess Austin would tell us about.
Austin, tell us about stablecoins and how has that become the next great marginal buyer of debt?
Yeah, so if we think about marginal buyers, a lot of foreign governments have been reducing their holdings of stablecoins, and the great irony of that is that the countervailing weight is that the people in those countries are increasing their holdings of U.S. treasuries through stablecoins. So, look, people greatly overcomplicate the discussion around stablecoins and also call a lot of things stablecoins that shouldn't be called stablecoins. But a properly constructed stablecoin is just a box that basically holds stuff that looks like T-bills and treasuries. Very simple. And it's just represented on a blockchain. Now, the important part of that is that there's two criteria, right, for you to get your hands on that. One is that you've got the internet, and the other one is that you have something of value to exchange for it. So like when I was at Paxos and running BUSD, the only country in the world where I was relatively certain no citizens owned our stablecoin was North Korea, because it fails that first test of people having access to the internet. Everywhere else they were using it. And when you go and look, there's actually a very significant preference still for the US dollar internationally compared to almost any other currency at the base level for people, right? It's a little bit like Churchill on democracy, where the dollar is the worst currency except for all the others. And what that means is, Tether is probably, I think I saw the stat today, the 7th largest buyer of treasuries globally now and growing. And so if we pass stablecoin legislation in the United States, you have larger and more sophisticated financial institutions that are able to issue these. Because look, whether you trust Tether or not, most people probably trust, Fidelity, right? BlackRock, JP Morgan to manage these things well. And that means whether other countries like it or not, which is kind of an important point on its own, we can now sell treasuries directly to citizens in other countries and let them opt out of their local system and local currency into US dollars at size. There's a very significant chance that the single most important thing Congress will do over the past 10 years and next 10 years is pass the stablecoin bill. And we could be looking at this 30 years forward as, well, that's the moment where they destroyed all but the G8 currencies, right? Everything else just got completely run over by this being generally available. Obviously, that is a very large source of funding for the US Treasury if we do that properly.
What changed in Congress and government? They were pretty against stablecoins for a while. Was it just, it was being bucketed in with all the other stuff of crypto, and there wasn't this deep-seated realization of the potential to, further out US dollar hegemony? Like, explain to us how is this track, this timeline where we are at now, where there's bipartisan support for the stablecoin legislation?
Well, so I'll start by saying I think there's been bipartisan support for stablecoin legislation in the House for a long time. Right, because if you look at people who are opposed to stablecoins versus in favor of stablecoins, the number one predictor is not political party, it's age. Right, like Richie Torres was on Unchained and talked about this and literally said the problem is the gerontocracy that we have on top of the Democratic Party. Right, because if you're 75 years old and still think it's 50-50 that PayPal is a scam, then certainly you're not going to be cool with stablecoins. All right, fine. But the House, I think, has had the votes for a long time. The change is the Senate flipping Republican because there's nobody in this country who hates changes to the financial system more than Elizabeth Warren. All right, and so when the Democrats and the specific Democrats, so this is not Democrats writ large, it's literally Elizabeth Warren and Sherrod Brown, were in charge of Senate banking, they were an absolute blocker on legislation. The fact that they are out of the way means that if they put the Genius Act to a vote today in the Senate and it could actually get to the floor now, I think there's 70-ish votes for it. And you'll notice there's only about 50 Republicans. So what does that tell you about the Democrats? Right. I think it's just the blockers being moved out of the way and the regressive party leadership on technology being pushed aside is giving the younger Democrats a chance to voice their real opinion.
Joseph, I want to ask you, with that said as a context of what's occurring on, the technological side of the innovation of US dollar, reserve currency hegemony, there's a lot of people that, talk about this idea of like the BRICS currency coming forth, the end of the US dollar reserve currency as an entity. But in the same vein, you used to be at the New York Fed, you were on the trading desk there, you were deeply involved in money markets, et cetera. And over there, for those that aren't aware, but there's been a very, very significant shift in recent years over there. We used to be on an unsecured standard, LIBOR, and now we're on a secured standard, SOFR. How do you think about this idea of the continuation of the US dollar hegemony? Because now if we're on a world where LIBOR was a global lending rate, and now SOFR is very much tied to US Treasuries. So, how do you view that trend continuing, and especially, taking into consideration some of these ideas of stablecoin innovation?
Well, the president has said, BRICS, if you want to use a new currency, we're just going to tariff you or sanction you 100% so that you'll never be able to do that again. So I don't know how effective that would be, but I think what the administration would like is, although you don't necessarily have to have a strong dollar because you want to boost your manufacturing, you do want the dollar to be a reserve currency. And the way that they're trying to do this is to move away from the sanctions and towards things like tariffs. So sanctions are different from tariffs in that, let's say, back in the Russia-Ukraine war, you could just confiscate someone's assets, right? If you are sovereign or if you are foreign national, you could potentially lose everything. That's a very different risk than saying that you'd have to pay an extra 10 or 20% to use a dollar or to use the US financial system. So if the US were to shift away from that standard of sanctions, trying to basically take someone else's money if we don't like you, then moving away from that towards something that's kind of more of a toll, more of a tax, I think that is positive for maintaining the dollar's hegemony as a global reserve currency. Now, as you rightly note, the standard has moved from an unsecured to a secured system. The reason for that is that one of the things we learned from the great financial crisis is that unsecured, it can be very risky. It could have systemic risk. So when the banking system goes down, all that unsecured stuff, that's not looking too hot. You can lose everything. If we have a secured system, and it sounds like the stable coins are going to be backed by very sound collateral, so maybe they could be perceived to be secured as well, right? T-bills and other aspects. So having a secured standard is something that could further strengthens, I think, the role and assets role as a reserve currency in widespread use.
Austin, I want to ask you, so let's get to this, macro crypto colliding moment here. We've already talked about this a couple times this week, but I'm asking you again publicly. But, around that idea of SOFR and all of that is the great complex of money market funds. And now we're talking about stable coins. So, where do you see this going? Are stable coins just a digital version of money market funds? And is it going to replace everything that is existing over there or, complement it? How does this all start to fit together?
Yeah, so I guess as a starting point, stablecoins in the Genius Act are almost literally money market funds, right? If you look at the form factor, it's a bankruptcy remote vehicle inside of a specific legal form factor that can't use leverage, but can buy T-bills and do repo and reverse repo on government securities. I've just described Fidelity's government money market fund, okay? Literally. It's a money market fund. And stablecoins are just a wrapper that gets those onto a blockchain. Now, where does this start moving things? Well, one of the trends we've seen post-2008 writ large, before we even get to blockchains, is a move away from opaque, credit risky bank deposits as something people prefer, and a move away from risky short-term commercial paper for which you don't pick up much yield. That was prime money market funds, and they've been shrinking, into one of two things, which is government guaranteed money market funds, which have been growing, or the balance sheets of the largest banks, because there's this perception that if Wells Fargo fails, the government's going to bail them out. So I'm not going to be in my local community bank. I'm going to be in Wells Fargo. And by the way, both of them are paying me zero yield on my checking account. So who cares? My personal view is Where these things will move is to realign sort of the framework of the financial system, and that the current modern bank is actually an incredibly dense entity that didn't really exist like 50 years ago, where your bank would be the one who held your deposits and gave you your mortgage, but like that's it. It wasn't also the biggest source of all your electronic payments and managing all of your assets and like handling all sorts of other stuff. These are incredibly dense entities. And one of the things stablecoins will allow for is the unbundling of the banking services, which is not to say the big banks will get smaller, but at least you'll have a better choice of the services that you take from them. And the other thing it's going to do is in the current system, because we tell banks only you guys can do electronic payments for the most part, okay? So like all of you are deputized. And all of the banks have decided, okay, well, we're going to offer the following deal to consumers. We pay you 0 on your deposits. We're going to go lend that money to other people, often quite risky. And when that works, we make a ton of money and pay ourselves huge bonuses. And when it doesn't work, well, you're going to lose your money on the deposits. That's not fundamentally a great economic arrangement for people who want to use the system for payments, but they're stuck with it because you've only got banks. Giving another option for that is going to force banks to compete for deposits at fair prices in a way that probably moves this sort of very large and implicit subsidy that we're giving to borrowers in the current system back into the pockets of people using the system for payments. And again, if we're thinking about a country that in general has significant levels of indebtedness and trying to figure out why this sort of market shift is probably not the worst idea.
Joseph, I want to get your take on that and also characterize it around, your experience being in repo markets and money market fund. Like, we've gone from this era of, along with going from LIBOR to SOFR, is this idea of going from, this corridor system for the Fed funds rate to this modern era where we have the reverse repo protecting the lower bound, and there's still some tweaks to work on the upper bound in terms of the standing repo facility for protecting that upper bound. But do you see any major improvements that need to continue to occur in that realm, or as things are good? And do you see any, interesting solutions that come forth from digital assets such as stablecoins that might help complement some of the whack-a-mole issues that have occurred over the last few years, like the September 2019 repo crisis that now has mostly been fixed? But yeah, how are you thinking about all of that?
So from what I hear, the description of a stablecoin is basically it's basically like a shadow bank, right? It's like a money market fund. It's maybe a potentially more efficient form of money market fund that, depending on how the adoption is for these stable coins, could be more liquid than actual money market fund shares. Now, as you know, the Fed has had an increasingly large footprint in money markets. In the past, the Fed would try to set interest rates by controlling the amount of reserves in the financial system, but now it's very much done through administered rates. On the lower bound, it's reverse repo facility. On the upper bound, there is a standard repo facility that could potentially put some sort of a ceiling. Now, I think these two are related because when the Fed is active in the money markets, that creates greater stability. And that actually makes anyone who is in the money markets a bit safer. So if you are a stablecoin fund and your assets are in T-bills and repo, you have the Fed there basically backstopping this entire market. That makes, on the liability side, your stablecoins safer. And so I think that would be, I don't know if they intended it to be, but anything that's linked to money market space to be a safer asset because there's less volatility and an implicit backstop.
I think another important point there is you look at how money market funds are constructed post-financial crisis is you don't have leverage in them either, right? Like if you're thinking about systemic liquidity issues, right, we have a live example of this, which I think people forget. So in the NYDFS has been regulating stablecoins since 2018 and basically been using a framework very similar to what's in the Genius bill. And they had a stablecoin that was, I think at the peak, like $23.5 billion, which was BUSD, that went basically to zero in the course of 3 months when it was shut down. And what happened in markets? Nothing, right? And who lost money on that stablecoin? Nobody, right? Like you can build these things correctly to the point that the only way you're going to have a stablecoin collapse in disorderly fashion, unlike, say, banks, which actually fail way more often, is if the U.S. Treasury itself is the problem, given the collateral, which is where the Fed providing liquidity is effective because the collateral is collateral you can provide liquidity against. We're not sticking a bunch of like really junk-rated ABS in this. We're actually using a government money market fund. And so to me, that is a fundamental restructuring, like you've been saying, of some of the building blocks here, but in a way that, knock on wood, so long as the Treasury doesn't blow itself up, is probably in favor of systemic stability.
There's actually a secret backup plan that in case the Treasury kind of hits a debt ceiling, that the Fed will still step in and backstop it. So you're good even in that case.
So you're saying instead of like an auction failing, they would step in for that?
No. So one of the potential disruptions in the Treasury market is something called the debt ceiling. So what happens is that the United States spends more money than it receives in taxes. So in order to pay its bills, it has to continually issue debt. That's why our deficit continues to grow. But what happens if we hit a debt ceiling? Then bills come due, but we can't issue more debt to finance that. In that case, so there is actually the House subpoena documents from the Federal Reserve Bank of New York, and they were gaming it out what they could do. What they could do is something called payment prioritization. So the United States, again, all this tax revenue and all this expenditures, you got to pay, military, you got to pay, grants and stuff like that, everywhere. What they would do, the amount of inflows from taxes is more than enough to cover principal and interest for treasuries. So they would prioritize payments to make sure that the debt holders received their interest payments, received their principal, but basically default on, say, the post office workers or someone like that. So even if we were to hit the debt ceiling, the treasury market would be okay.
All right, not political advice, but let's not try that.
Yeah, let's not touch that beast. Okay, last question for you both here is a two-pronged one, but the final two big components of this idea of macro and crypto colliding is one, this recommendation and this talk about a sovereign wealth fund for the US. And paired with that is also this, and I don't think there's going to be any answer here that gets people excited if it wants them to pump their bags, but the strategic Bitcoin reserve. How do you both think about those two potentialities, and what are they trying to solve, and is it even a good idea? Austin?
Yeah, fine. I'm going to get into trouble again. All right. So, one, I am on record of having said in the current environment, I think the Bitcoin Strategic Reserve is an absolutely pants on head stupid idea. So I'll just lay that one out there. And the reason is, let me walk you through the logic, okay? We're spending too much money. And so the way we're going to solve that is by spending even more money to go buy some lottery tickets, okay? Any financial advisor would tell you, for the love of God, don't do this. I would argue a Bitcoin strategic reserve at state level might make sense. There's some logic around that. And a Bitcoin strategic reserve, if we were running a surplus, I'm not personally in favor of it, but fine, whatever, do what you want. But a Bitcoin strategic reserve, while our problem is we're already spending too much money, and by the way, the primary thing that's going to pump the price of Bitcoin is continuing to spend too much money. You can kind of see the circularity inherent in that problem and what's going on there. How about instead of starting a reserve, we just, okay, I know this is going to be shocking. Have we considered spending less money? Right. So I think this is sort of the classic, it's like the alcoholic trying not to admit they have a problem about drinking behavior. We really just need to get to the core of the problem here, guys.
So I guess on the U.S. Sovereign Wealth Fund, at first blush, it sounds like a very strange proposition, right? Usually countries that have sovereign wealth funds have tremendous trade surpluses or some kind of windfall from their natural resources, like Norway, for example. They have all sorts of oil and gas. They earn a lot of hard currency that they deploy for the benefit of their citizens. But in the U.S., obviously, that's not the situation here. From what I hear from, say, Secretary Lutnick, the goal of that is to maybe capture some upside on companies that the U.S. invests in. For example, let's say that the U.S. offers tax incentives or grants to certain companies or certain sectors. Maybe in exchange for these benefits, these companies could offer the sovereign wealth fund some warrants or shares, so that maybe the U.S. is able to benefit from some of the subsidies they offer certain sectors or industries. So in that sense, that sounds like a reasonable idea. It will all come down to execution. So the administration is trying different things. I would give them the benefit of the doubt. Maybe trying something new, we get a better outcome.
All right. So as a final point, it's too bad Mike Dudas left because I'm about to give a rejoinder there. The other thing that I think is fun watching macro and crypto collide is how you can see like the different asset classes in crypto starting to mimic the actual behavior of asset classes in traditional finance. Right. And one that I would say to people, like back to the Bitcoin analogy, it is actually starting to behave like digital gold, which is how you can predict the thing. But I'll say my most fun analogy that I hit somebody with earlier today is one of the greatest parallels is actually between the art market and the meme coin market, because the primary purpose of both is actually still just money laundering.
I thought you were going to go on. I'm going to ask you for this analogy as well, but you say one of the big lessons for crypto is to not just keep repeating the same mistakes that the finance industry has already figured out, because I'm going to let you finish it and make sure you touch on the French quant blowing up too.
Oh boy. All right. So Felix is picking on me for my views on stablecoins again. Crypto, like in another parallel, is just speed running the history of traditional financial products. Like I was having a conversation with somebody about Terraform Labs, and he's like, "Isn't it weird that we built this unique thing and it failed?" And I'm like, "It's not unique, right? This is a self-referential equity node. There's nothing in crypto I haven't already seen a French quant blow up," is what I said to him. But the idea here, and what I think is important to move the industry forward in a meaningful way, is that the discipline of finance is certainly not perfect, and there's a lot of dumb things that happen there. But that doesn't mean over the many hundreds of years, thousands of years that we've been doing it, we haven't learned any lessons. And trying to reinvent a car from first principles when you can just walk outside and look at a Toyota is probably a bad idea, right, in the modern world. And so the other thing that I'm actually hopeful for that we continue to have a collision on is the crypto people actually bringing technological innovation to banking at the same time the banking people can bring, like, risk management to crypto, because it would be really nice to have a system that has both instead of neither.
Well said. All right, that's all the time we have. Last panel of DAS. Hope everybody had a great time. It was a great few days. Thanks so much.
Thanks.